Good morning, good afternoon, whatever time it is where you are, that is the time this video is taking place. Because reality is when it's experienced. And you're experiencing your reality where you are now. Again, Michael Bender with the Center for Fiscal Equity. This is the background video on tax reform from our center. We have in part one, and this is meant for members of Congress, the Senate, their staffs, the revenue committees, the budget committees, and people who are tax and budget policy experts, who work in the field, who lobby in the field, and concerned citizens who want to tell all these people that I've just mentioned that you support this or don't like it. If you don't like it, call. It's, I'll take because there's such a thing as bad opposition. If you oppose this reform plan, it gets noticed just as well. So please call. Do react to this, including subscribing, sharing. You can share and saying this Bender guy's crazy communist, or you got to look at this. It's pro-life. We'll talk about that part in a second. First, we're gonna wrap things up, or do a summary of those things that need to be changed. So in the first four videos, I talked about what to do about individually paid payroll taxes, and wage surtaxes, and whether wage and salary surtaxes can either be paid in one structure with public filing the way it is now, or having employers file salary taxes up to the 26% rate, and then have a second rate start above it. We'll talk about that now. Going up to 600 with a top rate of 26% or 52% if you don't have employer payment of salary taxes on wages. And then video 2 was about the subtraction value added tax, and it's just a tax that you don't that for the first tier you don't pay anything. You pay, but you don't pay. You pay your employees, and you adjust your invoice VAT based on whether you pay less than the stated rate in credits or more. So in other words, it's a refundable. The subtraction VAT is a refundable tax for employers. In other words, if they have more staff with children than is expected, they can get more. They can just lower their invoice VAT bill. And if they have less children than is expected, then they would pay a higher. They tack on a payment to their invoice VAT, which is collected quarterly like every other tax, maybe monthly. I don't know. That's a detail. That's the program, not the plan. You plan, then you program within the plan, and then you execute. This is how finance works. And then the last piece was about the invoice value added tax, which is a good and service tax. It's just a straight up VAT. I'm assuming for this that if you're watching this video, you know what a VAT is. I probably shouldn't assume that. A VAT is where you make something, or you grow food, or you mine something, and then you pay a tax on what you sell. And the person who buys that stuff pays a tax on it as good number zero. So there's and even miners. That's the thing. Even people who produce the resources, they have expenses, and those expenses the taxes paid for those expenses are taken out of the first resource. But we'll start at the resource level, and then the person that manufactures it, they pay the tax when they buy that good. But because they have expenses, when they sell that finished good, they take off their taxes. So they take off the taxes that they've paid. So you're not repaying a tax on a tax. There's the amount of stuff paid or used, and then there's the tax, and the tax is separate. The tax does not go on the tax. That's how a value-added tax works. That's why it's called a value-added tax rather than a retail sales tax. Retail sales tax is like the fair tax, actually. Unless you have the nightmare of producers not paying, which means people hide the money. You can't hide the money in a VAT. Tax cheating should not be a Republican family value. I'm sorry. So a VAT is better than an RST, and the way it works is that everybody pays for the value. Everybody is taxed on the value that they add, but not on what they buy. So you get resources, you get services, you pay taxes on those, and then you put it all together, pass it, and then sell whatever you did, and that difference, you pay taxes on that difference, but you get taxes for the whole process, and then you keep what you paid before and just send on the additional, the taxes based on your effort. So only your effort, not the effort of the people who previously paid taxes. So that's how a VAT works. Okay, so what are the provisions of this plan? So the items are, first, increase the standard deduction to workers making salaried income to $425,001 and over, shifting business filing to a separate tax on employers, and eliminating all credits and deductions. These start at 6.5, going to 26%. In $85,000 increments. This is assuming that there are higher tiered subtraction VATs in the subtraction value added tax, and then employers pay for the first salary on the bottom 26%, which is any income below. Well, it's all income, but the top tax rate for salaries paid is 26%, and there are various rates in it. So the person who pays the wage surtax is paying, or the taxes for them are being paid by their employer, the person who gives them a salary, but they don't have to pay the first 26% of their 52% tax rate at the top. And then you shift special rate taxes on capital shift special rate taxes on capital income and gains to an income and from the income tax, which is how it's collected now, to an asset value added tax. Expand the exclusion for sales to ESOPs or cooperatives. You sell it to an ESOP or a cooperative, and then you pay no tax. And then the ESOP would pay out or sell to their give to their employees one voting share, and then a bunch of deferred shares, a bunch of preferred shares, not deferred shares, so that they have the wealth, but they don't have a higher vote because they're more senior. That's if they want to be a cooperative. Right now there's an exclusion on paying capital gains taxes to ESOPs, but I would expand that exclusion to co-ops as well. Let's put it that way. And co-ops are just another form of ESOP, or could be looked at that way. And the mark option exercise and the first sale after inheritance, gift, or donation, as well as IPOs and short sales to market. Number 3 again is ending personal filing for incomes under $425,000. 4, employers distribute the child tax credit with wages as an offset to their quarterly tax filing, which ends annual filing for most employees. Also, they provide child care. There's a bunch of things that employers could pay through wages that the government gives credits to now for employees that are filing taxes. In other words, the employees don't file for social benefits, the employer does. And then they provide those benefits or pay the taxes so that the government provides those benefits. So who do you want to pay? It gets paid. You pay it. Who provides it? Is government better, or is the employer better? I think a lot of people would say that it's not the government. Again, employers collect and pay lower tier income taxes or wage taxes, starting at $85,000 at 6.5, with an increase to 13% for all salary payments over $170,000, going up to 6.5% for every $85,000 and up, all the way up to $3,400. You would then also shift the payment of hospital insurance, disability insurance, SM, I forget what that's, supplemental medical, also known as Affordable Care Act taxes, which are a bone of contention. That's one thing I need to mention. The Affordable Care Act surtaxes go away because income taxation goes away. So it is molded into the asset VAT. So you would just get rid of those taxes. If you don't like the Obamacare taxes, great. We'll get rid of them, and we'll fund it with a more broad-based tax. And this also, having these taxes paid through some kind of VAT would basically require that you credit things on an equal dollar basis, but it also removes caps. So there's no more cap on tax revenue. The employer-paid taxes could easily be called a subtraction VAT, again, abolishing corporate income taxes, and the SVAT would be, the subtraction VAT would not be zero-rated. You expand the current state, federal, and intergovernmental subtraction tax to a full subtraction VAT to a full GST, with limited exclusions. Food would be taxed, and add the federal portion, which would also be collected by the states. Yeah, this is the main thing. Make sure these make taxes that are invoice VATs zero rated at the border, and the rate would be 19.5% if it replaces the old age survivors insurance contribution. So I'm assuming that the general services tax, the VAT, goods and services tax, or the VAT picks up the employer contribution for Social Security, and then change the employee OASI tax to 6.5% from 18% to 85%, or 85,000. So from 16,000 to from 18,000. It's either 18 or 16. What it is full-time minimum wage worker pays no Social Security taxes, and then taxation ends at 85,000 for the Social Security tax. So the higher the minimum wage, the less the more money is collected, but the less it starts at a higher rate. So it works out positive for the government, trust me, and for retirees, which is key. So the next video will be about who wins and who loses from this plan. That is part 6. Part 5 is now concluding. Again, use this for your information if you're an advocate or an employee or an executive branch employee, and use it to make your decisions on who to vote for and what to support if you are a citizen, which most of you are both, or some are both, but most of you are at some point. Who watch this video. If you're not, then you are, we thank you for your support if you're watching this and you're not an American taxpayer. So that's the summary. Now, next we'll talk about pluses and minuses. Again, thank you.